Okay, this is Professor Hazara. This is the third, and it's going to turn out to be 4 videos, I think, because I'm going to try to keep these short. The last one took a little bit more time than I'd like. It's the nature of the beast. But what I did is in the first video, I did the problem, kind of went over some things, and I've circled a bunch of stuff there. In the next video, I did the calculations, and in this third video, what I'm going to do is I'm going to do the consolidation entries. There's 6 of them. Only 4 matter, really. Well, these matter. In real life, they matter, but conceptually, it's not a big deal. And the final video, I'll actually do consolidation. So these next 2 should be relatively quick. Okay, now, when you have a consolidation with non-controlling interest, and I think we're fortunate because we have the view of the entire analysis here. When you have a consolidation with non-controlling interest, you're not going to have 3 big entries. You're going to have what I call the big 4 entries. The first one is going to be, and the first 3 are the ones that we've been starting to look at in the other consolidations. The first one is going to take your ending balance and investment account from the ending balance to beginning balance. Next one is going to be to make the beginning balance 0. So we'll take the first one takes you back from 515 to 200. The second entry, we're going to eliminate that 515 to 490. And we're in the second entry, we're going to eliminate the entire 490. The third entry, we're going to record current year's expense. And this is the one we did not have in the last consolidation, because we didn't have a minority interest or non-controlling interest. And kind of important. This is really fundamental to consolidations. That's why I'm putting these in here. You're going to have an entry which is going to update the non-controlling interest. Anyway, let's go ahead and get started with this. All these 4 entries, for the most part, these 4 entries, which are the most important ones, are mostly based on this analysis right here. The expense entry is based a little bit on the income, but the 4 entries are based basically on this entry right here. Okay, so the first thing is the purpose. The first one is, I'll put the purpose here, is to reduce investment account to beginning of year balance. There it is. Okay, that's what we'll do. So the end of year balance is 515,200. By the way, is matched with the balance sheet in the last video. We've got to reduce it to the 490, which is beginning year balance. Okay, so let's go ahead and we'll just do the debit here. And so the difference between the ending and beginning balances is the net income and the dividends. So if we take out the net income, take out the dividends, and plug the difference, by default, the difference is going to be the difference between the beginning and ending balances. So let's do that. Okay, so we're going to have a debit to income from sub, 60,200. We are going to have, and it's going to be a credit to dividends for 35,000. And whatever you put in the investment is the plug to get a balance. In this case, it just happens to be 60,200, 35,000, 25,200. Now, if you take conceptually 515,000 and take out that credit for 25,200, we'll end up with 490. So after entry 1, we have a balance of 490, at least on the consolidation worksheet. So now that we're back to 490, we've gone from here to here, because we've taken out the $25,000, 25,200 difference. Now we're going to take out the entire 490. And here's how we're going to do this. Rather than deal with the 70% account, what we're going to do is we're going to just list these amounts. We're going to just take these amounts at their 100% values, which equals 700,000. Notice that all I did in these debits here, all these debits here, is just a list of all the debits I have there. So once you have this table, journal entries are kind of made for you if you kind of understand the logic. Okay, so I'm going to take this at 100%. I'm going to take all these accounts at 100%. These are my debits. So I've got inventory for 5,000. We wrote up inventory that when we bought the company for 5, buildings for 14, equipment for 21, and we have goodwill of 60,000. Okay, so when you do this entry, take the amounts, debit the amounts at their 100% values. And then since you've got 100% on the debit side, which equals 700,000 by the way, the easiest thing to do to get this thing to equal is have two credits. One credit is going to be to the investment account, which is going to make it zero, by the way, because that was your beginning balance and now you're crediting it to make it zero. But we'll get to the consolidation. And then the other credit will be to something called non-controlling interest. And so we'll have the non-controlling interest is on the consolidation. This is your first introduction to it. Non-controlling interest on the consolidation is going to be kind of the plug number because it's going to be a plug number which is 30%. If you're going to have 100% of your assets on the left-hand side of the consolidated balance sheet, you better have 100% of your equity on the right-hand side. Okay, so anyway, so that's that entry right there. Okay, so the purpose of this entry, I'll even write the purpose of this one. Okay, and this I'm just going to put is, I'm going to say purpose of this one is to reduce beginning investment balance to zero. Okay, so first thing we did was we took it from 515 to 490. Then we reduced the 490 to zero. The next two entries have to do with expensing, which is more of an income type entry. And the final one is going to be, or the final important one is going to be for the non-controlling interest here. Okay, and so for entry number 3 here, what we're doing here is recording this year's expenses. So I'm going to put here, the purpose of this one is to record 2011, which is the current year. That's the year consolidation expenses. Okay, and so we're going to have the expenses we have are the expenses we've been dealing with all along in the first two videos. There are these adjustments here. These adjustments here. We're going to expense all of the expense, 100%. So we're going to expense $5,000 excess cost of goods sold, the sum of those two. We're going to expense $2,000 excess depreciation for inventory. And what is that? $7,000 excess depreciation for equipment. So let's start with the inventory here. Okay, so the inventory we've written down, we're going to write down by the entire amount because it was all sold in 2011. We dealt with that in a sense on the first test. And since it's already, I'm going to make it a negative to take the sign out. Okay, so it's going to be that number plus 1,500. So we're going to take out the entire 5,000 by which the inventory was written up because all the inventory has now been taken out. Next, equipment. The excess depreciation on the equipment is, or what am I saying here? Let's get, we'll do the equipment, doesn't matter. Then we'll do the billing, just slightly out of order. Okay, so that is equipment 7,000, that's good. The buildings we're writing off over 2 years, and that's 2,000, I believe. Yeah, looks good. According to my sheet here, just a little bit slightly out of order. $2,000. Okay, so we're going to write down buildings at a rate of 2,000, which is 14,000 divided by 7, if I recall. We wrote by 4,000, 14,000, and they have a 7-year life, so it's 2,000. And equipment was written up by 21, has 3-year life. Inventory is just written off over 1 year. Okay, so the excess cost of goods sold is the amount of expense due to the current sale of the inventory, and then the depreciation is going to be depreciation on the buildings plus the depreciation on the equipment, $9,000. So your entry should balance there. Okay, now the fourth of these entries is the one we haven't had so far. It has to do with non-controlling interest. And the purpose of this entry, and I'll just put it here, the purpose of this entry here is to update the NCI, non-controlling interest. I'll go ahead and put a row in here so that we don't. Okay, to update non-controlling interest. And it's good that we have this table here once again. Shrink it down just a bit here. And what we're going to do here is we're going to be dealing in this row right here. The non-controlling interest, so far what we've had is, it's like equity in a sense. The non-controlling interest that we have established so far is your beginning non-controlling interest. That's the, look right there. Non-controlling interest at 1/112, 210. And that's 210 right there. What we've got to do now is update it to its end of year balance of 220,800. Okay? And what we're going to do is, it's kind of similar to this entry right here, to the first entry. We're going to, in a sense, eliminate the non-controlling interest income. And that kind of makes sense. When we get to the consolidation, you'll see we treat that like an expense. And that kind of makes sense because this is income that doesn't belong to you, so it's got to be taken out of, it's like an expense. It doesn't belong to you. So if you recognize the entire net income, you've got to pull out that your share, the share that's not yours. Okay, so what we're going to do is we're going to debit non-controlling interest net income for their share of the non-controlling interest, or the non-controlling interest share of income. Then we're going to credit non-controlling share of dividends, which is going to eliminate the dividends for the non-controlling interest, at least on the consolidation worksheet. And the plug, this is the plug. The plug is going to be to the account non-controlling interest. It's sort of a new account that you've probably never seen an account before. This is going to be to the account called non-controlling interest. That entry is going to be for 25,800 minus the credit there. So that's for, let's do this right. That is equal to 25,008 minus 15 gives you 10,800. Okay, and maybe it was a good thing I did this, because here's what the impact of the entry is. We only have two credits to non-controlling interest, that one and this one. This is the same account. I'm just going to call this, I'll put this in here to introduce it. We call it NCI, non-controlling interest. Okay, so NCI is the same account as this one here. When I refer to non-controlling interest, NCI is non-controlling interest. It's kind of neat to see what's happened. What we've done is, beginning non-controlling interest was 210. We added income, got dividends, ended up with 220,800. If you look at the two credits to non-controlling interest, this is just something I'm showing you, 210 plus 10,800. So on the consolidation, your new non-controlling interest, your year-end non-controlling interest, will equal the correct balance right there. That's what we did. Okay, just a couple more entries. If you go back, I'll explain one, and the other one, this book just loves it, so I really wouldn't care if you had on test. If you go back to the text of the problem, it says in the third paragraph that one company owed, there's 10,000, the subsidiary owed the parent 10,000. You can't owe yourself money on receivable or payable, so all you're going to do when you see those things is debit accounts payable for 10 and credit accounts receivable for 10. Problems may or may not have that. Okay, and then finally, dividends payable, dividends receivable. I'll explain it when I do the consolidation, but this is important, but not that important. But we're going to have an entry to debit dividends payable for 14,000. I'll explain it in the next video. And credit dividends receivable 14,000. Basically, it's they owe each other. The subsidiary owes the parent dividends, and from a consolidated perspective, you can owe yourself dividends. And basically, it's 70% of, if you go to dividends payable right here, 20,000. It's 70% of that 20,000. You can owe it to the outsiders, non-controlling shareholders, not the parent. So anyway, so main thing to remember is that these four entries here, these four entries right here, for on every consolidation, assuming it's a non-controlling interest, which is the vast majority of consolidations. And those four entries basically come from this analysis right here, a little bit from the expensing and the income account. Anyway, so in the next entry, I'll finish the consolidation. And I'll post these to YouTube. Thank you very much. Okay, so go to recording and stop.